Hi, it's Fred from CappThesis. Today we'll be looking at why the CPI data is so important to the S&P 500. We'll also take a look at the most recent upside target that the index just acquired a few days ago and examine the reason why the last few weeks were among the strongest since the October low. So let's start with this chart, which we've actually talked about before, showing the CPI dates going back to the beginning of 2023. And we have here colored in blue the times when the S&P 500 was higher 2 weeks later, and in red when it was lower 2 weeks later. So we came into today's data when the CPI report was released up 4 straight times, again, 2 weeks after the report. And that hasn't happened in at least a year and a half here. And so it's important to realize because the market has been higher, of course, for 5 months now, but really it's important because things really changed for this uptrend after that report from November 14th. Now, we know S&P was already up a good amount from that point, and that was actually the fifth 1% gain in 12 trading sessions back then. But really, the initial part of that was an emotional snapback, and things morphed into a more consistent, trustworthy uptrend after then. And so I've gone now 78 trading days since that point. The market has logged an additional 9 1% gains versus 4 1% losses, but still not nearly as strong and driven by emotion as it was at the beginning. So that's important. And going forward now, it's really not about what the CPI data shows us. It's a reaction that the market shows to it, because you can break these reports down any which way to come up with a reason to suggest that inflation is heating up or cooling off. But it's the market's reaction to any news at this point that's going to give us an idea of how long this rally can go on. Because in the best markets, in the best uptrends that we're dealing with right now, news of any kind is rewarded. Good news, of course, is treated very well. Bad news can be isolated, which is, of course, what we've seen. What's going to matter, of course, is if bad news is treated as it should be, with the market going lower. More importantly, if good news starts to be ignored, right? That hasn't happened yet, but again, things we're looking for as potential change. And because the market has been doing well from this angle, it means that upside targets from bullish breakouts like this continue to work. And this is the latest one, which we've talked about, finally got that upside target acquired when the market opened higher. It's last Friday, March 8th. And so, of course, higher from that point. But that means that we've now had 4 straight upside targets hit from successful bullish patterns. And we've shown this chart last time, and now, of course, this is the 4th one. And to review what we call a successful bullish pattern, a few things have to occur. Number 1, hold support. Number 2, follow through, have a higher low, which then forms the actual pattern, have a breakout, most importantly, have that upside target hit, and repeat those steps through 6. And of course, that is what's been going on. We saw the much bigger pattern with the upside target of 5,030 hit as well. But just as important are the smaller ones, because the same type of process needs to get accomplished for that to occur. And again, higher low, bullish pattern, breakout, target hit, so forth and so on. And that is the epitome of how things can work and how uptrends can be formed and extend. We know, again, this is not going to go on forever, but we can't just believe that's going to stop all of a sudden without seeing signs of it doing so. And so looking at this in table form, we can see it that the gains have been somewhat strong, right? 10%, 6.5% in just over a month. But the smaller ones, again, just as significant, because we need them to occur in order for the biggest patterns to be formed. And of course, we're talking about the one that has a 6,100 target on it. Now, this 27% move would be from the actual breakout zone 4,800. With the market almost 400 points more than that, is getting closer. And so this is what it looks like. Again, we've shown this from the very beginning. And the most important thing that's happening now, in addition to getting closer to the upside target, is moving further away from the breakout zone, which gives the market the ability to pull back and keep this upside target in play. And so why have the last 3 weeks been among the best? Well, we look at, again, this daily price action very closely for clues. And one of the things that I've noticed recently, over the last 14 trading days, the market has only had negative breath twice, back on the 26th of February and on last Tuesday, March 5th. But, and other than that, we've had positive breath. Very important, of course. And we can look at this in various ways. The cumulative AD line, of course, continues to make new highs. We also talked about how the percentage of stocks trading above their 250 and 20-day moving averages matter a lot. But really paying attention to what happens any day is important as well. Because remember, we had that big negative reversal led by NVIDIA, large cap tech. Market finished on its lows, but still had over 50% of its stocks advance. Just as important was that big down day on the 5th, down 1%. Only 35% stocks actually went down, which is not a real lot considering that the market was down 1%, right? And so considering all that, if that starts to change, if we start to see a lot more down days, of course, I mean, it sounds overly simplistic, but looking for that and not getting it has kept us in the game, kept us on the right side of the trend here. When that starts to flip, and we see a lot more closes underneath the midpoint, so forth and so on, that's when the tide could really change. Still haven't seen that just yet. And so one area we're looking at specifically for an indication of things changing is the XLC Communications ETF, because of course we know that it's mostly driven by Meta and both of the classes of Alphabet, which together make up about 50% of this ETF, but there are other stocks in there as well that have at least gone along for the ride. And so the most important thing from a pattern perspective here is that the XLC just continues to form bullish patterns and break out from them, make new highs, consolidate, so forth and so on. And most recently, it's been consolidating over the last number of weeks. Hasn't pulled back though, right? Some other areas have really pulled back harder in terms of the large cap space, or other areas, other stocks within the Magnificent Seven, so forth and so on. XLC has quietly just moved sideways, getting ready for potential next breakout. So again, when this stops working, when we see a breakout that fails, when we see a consolidation phase that then resolves to the downside in a very important area like the XLC, then we will start to get more worried that things are changing, just not yet. That's what we got for today. Don't forget to check out these videos and subscribe. I'll talk to you next time. Thank you.